Welcome to the Generous Benefits Podcast, where we help employers create meaningful people-first benefits that make a real impact. I'm your host, Amanda Brummitt. Today's episode is a little extra special because I'm joined by my favorite human, Bret Brummitt, founder of Generous Benefits and longtime benefits strategist with a passion for making insurance work better for employers and their teams. Bret has helped countless employers rethink how they approach cost, coverage, and care. He's known for his ability to take complex systems, like, say, the entire U.S. healthcare market, and make it understandable and actionable. And today, we're tackling a big one. Why do insurance premiums keep rising? We hear it every year. Costs are going up again. But why? What's really driving these increases? And more importantly, what can employers do about it? Let's break it down. Welcome, Bret Brummitt.
Well, thank you for asking me, Amanda Brummitt.
This is your first solo appearance on the show, right?
I believe.
Yeah, fabulous. Well, I have told people two things: that you are the founder of Generous Benefits and that you are my favorite human. But otherwise, I haven't told them about you. So why don't you take a minute, no longer, and tell us who you are, personally and professionally.
This is the hard part for me, but I am a pretty good, deep thinker when it comes around health insurance, theology, life, humanity, how to be kind to people, and where I'd like to see the future go. I'm somewhat well known for some kind of technical prowess, though as I start to turn 50, I think that is no longer what people know me for.
Sorry,
because
buddy.
I am aging out of the tech guru and time is passing me by. So I try to stay super relevant now with healthcare costs.
All right. Did you go to college? Do you have any children?
Yeah, got a couple kids, went to a couple colleges, even decided to get a master's degree a few years ago just to prove that I could do it, not because I needed it, fun stuff like that. Weird diatribes. I'm out running, trying to learn how to be a marathoner at age 49. So most mornings I'm up at 4:30 or 5 o'clock or 5:30 out running the streets. And then on the weekends, I still play old man baseball. So I do everything, play a wood bat league. I slide, I injure myself. My wife thinks I should no longer try so hard and that it's not the World Series on Saturday at 2 o'clock.
Not worth a hip fracture at your age.
I won't be making hip fractures, but ankle fractures and wrist problems are probably real concerns, especially at my weight. I do a little heavy for playing late and running late.
Yeah, but it's so cool when you steal bases and surprise the other team.
Yeah, it's
Like a
cool most of the
costume.
times. It's really humbling when I am non-successful.
All right. Well, let's transition into something that you are wildly successful at: health insurance.
Fantastic.
Yeah. So our goal today is explain why premiums keep increasing and what people can do about it. So let's start at the top. Why do premiums keep going up every year?
Well, the main driver is super simple. The cost of care keeps going up, and insurance companies, if they're fully insured, are not looking to lose money. And self-insured employers or partially self-insured employers have to increase the cost of what they're booking for claims from what you pay for it so they can pay those increased costs and claims. And just this last week, PwC released their report that this next year is going to be, again, a third steady year in a row of a 10% cost in care. Now, you and I have had multiple discussions around what goes into that. But, we're seeing the promise of consolidation not necessarily be so good. We've seen lots of medical practices consolidate, roll up to larger practices because larger practices currently have a higher reimbursement for the care. So those companies that had lower reimbursements are joining bigger, better contracts. So the cost of care has gone up.
You mean it doesn't get cheaper or better for the patient?
There's another piece in there. No, it hasn't. It should. It hasn't. It probably has in very small segments. but that's not what we see in practicality. The other part of that, this consolidation, the goal is, hey, if there's less overhead, there's better technology, the systems align. We've only seen an increase in the administrative staffing. When you look at the numbers in the reports, I mean, that's, now a 15 plus year trend of a massive increase of non-clinical staff and care. And the saddest part of the increase on the cost of care, it's not going directly to the providers. Very little of those are going. It's going to the admin staffing, the billing, the oversight, the people that are figuring out how to find money that's not being collected, and the investors that are funding the consolidation. So there's a lot of non-clinical people receiving a lot of our care, and our doctors, nurses, support staff, the clinical support staff are not really people seeing it. And that's been the case now for several years. Inside of this current 10% year, that trend has gone down a little bit on the consolidation of those have slowed down somewhat because there's not a lot left. And specialty drugs and high dollar brand names are starting to make up with those. So, the biggest, well known are GLP-1s, the Ozempics, Manjaros. Those are super high dollar compared to other diabetic medications. And those have taken off rampantly. So we've replaced $50 a month drugs with $1,000 a month drugs. That math is pretty easy to see. Now, we'll call them $1,000 a month drugs with the caveat that there's a $300-$400 rebate in there too. So, I mean, maybe they're $400 to $600 drugs these days. But even $50 to $400 on a good case, that's a large increase to absorb when that's being paid out in a pharmacy claim where someone's paying, you know, $25, $35 copay for their drugs on a diabetic use case. And then you have the employers that cover weight loss in that area. And as those are covered for those purposes, those copays, again, are not full cost of drugs. And that drives the care, even though that's not a majority of the population, it's still an increasing higher percentage of the employee population on that part. And then we've just seen a real rise in the frequency of the super high cost specialty medications, especially cancer medications in the past few years. And it's been painful. I mean, as I watch $18,000, $23,000, $24,000 per month drugs come into an employer's claims fund, that's a large dollar to absorb. And most employers aren't absorbing all of it. There's a reinsurance or someone else that's picking up part of it after it hits a certain threshold. But as those vendors pay out money, they're going to recuperate it, and that's renewals the next year. And that's really what's driving the cost most of all. I mean, those are the easy culprits. With anything in healthcare, there's a lot of culprits and a lot of drivers, but those are probably the
and
biggest
not one
three.
terrible. I mean, hospitals are a huge part of that, but hospitals aren't inherently doing bad things or exploiting people financially, and doctors
Not,
aren't
not all hospitals are inherently doing bad things.
Yeah, there's
Not all
good and bad players for
there's
sure.
nefarious players within the space. I mean, and there's a lot of fraud. I mean, we just saw the biggest, fraud case come down. Now, not really targeted to the employer population quite as much, because things tend to fraud, or people tend to defraud big, large, faceless entities. And so defrauding Medicaid doesn't seem so bad, or you can talk yourself into it because it's just, so much money, and it's a country or people. Like, it has a direct impact. I mean, same thing happens with employers. If you think you have Blue Cross, I mean, you do have Blue Cross, but really your employees are paying for Blue Cross through what the employer pays in reduced wages and what they pay out of their hard-earned wages. Like, you're paying for that, which will go up. And insurance, it's a risk avenue. And if there's anyone other than the employer paying a direct cost or the consumer paying a direct cost at the point of service, like, there's a middleman that has to make money to survive. And that is going to have an increase over time.
Yeah, for sure. Before we move on, one more quick question. On the GLP-1s, are they getting a bad rap within the insurance community because it's super easy to tie back to, versus like if people are lowering their weight and being able to put off a knee replacement, or they don't have that heart attack, or whatever, but those things are harder to quantify. Is it because it's easily quantifiable?
Yes. And there's stereotyping in there.
Mhm.
Like the person that is heavy and is able to put off the weight loss, like, oh my God, they should have eaten better. They shouldn't have stopped at McDonald's. Like that, which is not necessarily accurate, but the stereotyping of it gives it a bad rap of, oh, it's our standard American diet that's the problem. It's not the GLP ones on the weight loss. We should have done things preventive, you know, 15 years ahead of the fact. Like,
Yeah.
here's the deal. Insurance for most employers and most consumers is a year to year value proposition. No one looks at it at a 15-year trend. If we did, if
Sure.
we needed to invest in something for a 15-year thing, we'd actually invest in it and really work on those downstream items. But employees don't stay at employers long term like they used to. People don't purchase long term like they used to. And
Right.
so every investment you make to improve population health is investing in someone else's future employee. And that
Mm.
super disincentivizes any organization, be it an employer or a health insurance company, to try to improve your life so that you can save someone else's claims later down the road.
Yeah. That makes sense.
Yeah.
For sure makes sense.
Super downer. Sorry about that.
Yeah, no, it's okay. And I'm gonna move on, but I'm gonna say one last thing before I do. I have people in my circle that stay at their job because their GLP-1s are covered. That's all I'm gonna say.
I have employees of my clients that stay at their jobs, and we look at things that are these improving our health. And that is the question. It's the catch 22.
Yeah.
Are we going to risk paying $1,000 a month for 6 people when one person's actually going to use it to prevent, you know, a knee surgery? Or are we going to spend $600 a month so we can save, $80 a month in high blood pressure medications? Like the math, that it's
Yeah.
the math. The math is
You're right.
why the short-term math is why it has a bad rap in the industry. And why does it have a bad rap in the broker consultant industry? We are tasked with making sure the employers don't spend too much money. And that is a rapid increase from the time, even 4 or 5 years ago when
Yeah.
I decided to use an Ozempic for a weight loss initiative and, texted some of my buddies and said, oh my God, this is being covered for me. And I'm just borderline. This is
Yeah.
going to hit us all really hard, really soon.
Yeah.
And about 6, 7 months after that, we started seeing all of the webinars about how are you going to control your GLP-1 costs? How are we going to do
Right.
this and all the other things? And it's getting better. The industry trends are getting better with us being able to get rebates directly back to employers. I mentioned the $1,000 cost, but there's a rebate
Mhm.
out there.
Mhm.
Where are those rebates going? Is it going back to the employer? How soon does it go back to the employer? Is it going to be treated as part of what they're paying on their claims fund? Is it going to be treated is the carrier getting, is the PBM getting, like who's retaining that?
Yeah.
Those are questions that are currently being asked and answered. And because those questions have so much buzz around them, it's improving the overall system. So are they a pain point? Yes. Do they have a bad rap? Yeah, they have a lot of bad rap. But again, it's back to, are we looking at you know, a 15, 10-year like improvement? Are we looking at 1 year? And if you look at 1 year, what are you offsetting? You're not seeing a dollar for dollar financial offset.
Yeah. That makes sense. Okay. So a lot of employers hear all this and they feel like they have absolutely no control over what the hospitals charge, what the drug companies charge, what the doctors charge. So therefore they have no control over these increases. Do they just have to accept the renewal and move on? Or are there things that they can do to leverage anything?
Yeah. Employers of all sizes have tools in their tool belt to leverage that. Now, it comes in a lot of different forms depending on your size and depending on your willingness for disruption and noise from your employees. And that's really the biggest question. Like how much disruption to the employee experience is an employer willing to go through to undertake the savings?
Yeah.
Most employers have jumped from one insurance carrier to another carrier to save a few percent each year.
Hmm.
Problem is everyone's done that. And in that world, there's just not that many fully insured carriers to go around and jump for 2-5% savings each year. And you're just, you're in a circular motion with no real long-term strategy. And that has caused the rise of most employers, even the small ones, to do some form of self-funded, whether it's a level funded plan, some kind of, MERP or gap plan bridge to a high deductible to do something.
Define MERP.
Medical expense reimbursement plan.
Thank you.
The problem with defining that one is they come in so many flavors. It's just fun to say MERP. But yeah. And reimbursement plans, other programs, level funded, self-funded, the programs where an employer now can realize their own investment immediately versus trying to wait till next year's renewal to hope and pray that it's going to be lower. Like those plans in that self-funded platform of some process give employers, and that goes down to employers of 2 employers in most states now. Those have been coming downstream. We've seen reports like the Kaiser Family Foundation reports that even the small employers, we've seen like over 40% of those, 35-40% of those employers have moved to a level funded plan in the under 50 employer crowd.
Nice. Maybe?
Well, caution that with every trend comes a reaction. And so that could have some kind of reaction in the next year, few years. And maybe on the good side, maybe this helps market correction on fully insured plan.
Mm-hmm.
So being in the trend now is great and it gives power, but there's still something to be said of like, what is the long-term strategy? Just being on a level funded plan is not a long-term strategy. It unlocks the door. Like, how are you going to invest in the things? And so the other trends we're seeing are, for several years, we've seen narrower networks. Employers can choose. I mean, you mentioned back to like choosing one to the other for hospital cost. When you're talking about big national PPO networks, they are reimbursing employers roughly the same if you look at a big global. Now, in certain markets, you might say for this one procedure, United Healthcare pays by far the most and Blue Cross pays by far the least. That's microscopically looking at one procedure. If you take the whole kit and caboodle and across the board, they're within, most of the time, 7% of each other across the board. Now, 7% is a lot of savings, but 7% on a healthcare procedure doesn't equate to 7% to an employer's bottom line because someone's still making a spread on money on there. So 7% savings on a healthcare procedure network discount is probably like a 2 to 3% employer savings. So it's not a percentage to percentage when you hear those numbers. But the narrower networks are designed predominantly around like, who are those high quality providers and can we negotiate with them to have a lower price point? So those narrow networks have a lower price point for care. Now, traditionally, that's an HMO network over a PPO network. Traditionally, and now we're talking like 30 years back. Yeah. But we've had more narrow PPO networks, more narrow networks built in like tiered networks, like a tier 1, tier 2, or people call them incentive networks. It's a select subset of the larger networks where employers are incentivizing either super low cost care because they're saving on the cost of care or $0 care through those networks. And those have had huge impacts that employers are adopting. And there's employers may be doing that directly with the carrier, directly with their self-funded plan, or they may be looking at one of the few carriers like we've done where, we've contracted with a turnkey solution that uses a incentive network for care. And so that has helped, bridge one to the other. Does that, again, create like a 5-10 year strategy? No, because every time you start lower, you're going to reset and start rising higher again. So your job's not done by just moving from fully insured to self-funded or level funded. Your job's not fully done moving to an incentive or narrow network. Your job's not done investing in one thing. You've got to continuously improve all of the strategies. Because again, like I said, small employers have moved from fully insured to level. Larger employers have moved from fully insured to self-funding. That alone will cause a trend that creates market disruption for the larger vendors to where they start recreating and reinventing their plans over time because no one's going to lose market share. And so there will be reactions where you have to continually improve and continually have oversight of a plan.
So what I'm hearing is if your broker comes to you at renewal and says, here's your increase, one of two things have happened. Either they're lazy or they've looked at all the other options and none of them are viable because of your health of your group or something like that. So
or they've made assumptions about your tolerance of what you are willing to go through as an employer. I mean, that I am guilty of that because I've worked with an employer for 4 or 5 years. So I may look at things or may choose not to look at things because we've had conversations year over year.
Mm.
So, I mean, there's a good, like, what message have you given your broker consultant? Like,
Yeah.
what are the unsaid messages your team has given them year to year when you try something new?
Yeah.
Like, or are they willing to risk your account because they're scared of doing it wrong or you having a bad experience?
Mm.
Most of us in this community understand we're only as good as our last piece of advice.
Yeah.
We get compensated for the results of the advice we give. So some of us are very conservative on the solutions we'll pull out and show somebody.
Yeah.
That there's
So
different
ask.
flavors.
If your
Ask.
tolerance is there, push your broker and ask.
Mhm. Yeah, and talk about the disruption you're willing to have for your employees.
Yeah.
Like, we are willing to only cover a third of the doctors if we can save money.
Mm-hmm.
Well, what if that is, a key employee's pediatrician? Like,
Mm.
are you willing to have that problem?
Yeah.
Like, that's become one of the things we've seen.
Yeah.
The more restrictive the strategies, the more adjustments have to be done when you find out something you didn't know about 3, 5, 6 months later. When somebody's getting turned away for care, they can't afford to go back to the person that's been the fantastic provider for someone going through a chronic care journey. And,
Sure.
and talk about those scenarios and the different ways to bridge it if that comes up. You know, the nice part of the self-funded plans, for the most part, those are all things that can be adjusted on the fly, addressed immediately, not having to wait till renewal seasons,
Mm.
and improved across time. Now, is there a cost to do those things? Yeah, of course there is. And so talking about that financial cost of what it's going to take to put the manpower to get, maybe a one-off contract. Maybe that's already in their plan service agreement. Maybe that's outside their service agreement. Do they need to have some other kind of Band-Aid to put on top of it to cause or fix a problem that you've accidentally caused by saving money? Yeah. Sometimes we just have to say, yeah, well, we're saving money across the board, and this is going to have to be a pain point we survive and go through. And that
Sure.
may be your, mentality as an employer. Talk about those things so that you're giving your consultant all the tools they need.
Yeah, that makes sense. And now let's talk about on the carrier side, sort of carrier math. What are the financial incentives, business models that drive costs up and ultimately impact employee pricing? And maybe even explain like community rated pricing versus actually underwritten rates.
Sure. This comes back to your very first, like, what at your most basic level, what are your two kinds of plans? Fully insured. So an insurance company charges you a cost. You're paying the cost. There's no volatility in it. And your renewal next year is either determined by your larger community, like your geographic, 5, 6, 7, 8 county rating region for a community rating plan. So how well your larger geographic community performs, that's community rated. Experience rated means how did your own population experience health claims? So if you have a renewal and they say, well, you spent 150% of what you paid in, then your experience is going to drive your renewal. Now, the shady tactics behind that might be that you spent 150%, but then the fully insured carrier also received 65% back in specialty rebates, meaning you only spent 95% of what you paid in, but they don't allocate to that at renewal time. Rebate numbers on a fully insured plan do not come back to an employer's experience.
Does the employer know they exist or
No,
that they happened? Okay.
no, no, no. That on a fully insured plan, that is either going directly to the fully insured carrier, or some programs give it right back to the member at the point of service.
Okay.
But if that was the case, then it wouldn't show up in a claims fund.
Gotcha.
And there's other items. All fully insured plans have their own reinsurance program built into them. And so even if someone spent $200,000 of claims, there's a pooling point in those plans where the claims over a certain threshold are taken off the books and put over on another set of financials. Now, it's still being paid by the insurance company of their people.
Mm.
And it's still a really good litmus test of knowing where your group is on a paid in versus paid out basis.
Mm.
And so that's a good way to know how your group's performing. If your group is only, spending 30% of what you pay in, this might not be the best financial arrangement for you. If your
Yeah.
group is paying out spending 400% of what you're paying in, it's probably the perfect financial arrangement for you. It's
Yeah.
all about what your group is based on size and claims experience and people. Within the carrier math, other incentives, once you start getting into that self-funded world, you start with the baby plans, the level funded plans that are, self-funded on training wheels that don't have a lot of financial requirements from an employer, up to beginning regular fully insured, some of the captive stop loss. So you're able to group purchase your stop loss with another band of employers. And then you guys are rated, quasi grouped together. So you're able to cushion your experience. So if your company has a spike in claims, you're offset by, 50 other companies where you've worked together. They're
Yeah.
collaborative models of purchasing.
Creating a risk pool.
Creating a risk pool. Exactly. And then there's other different middlemen that get in these financial models and plans. And there's a lot of different program solution vendors that charge either a percentage of savings. So like, hey, your claim was 20,000, we got it reduced to 5,000, but we're taking, 10% of that. So we're going to take that percentage on top of it. So you're paying the claim plus our savings percentage versus, or a flat fee, like a $5 per employee per month fee. There's a lot of other, bloat that you can start adding into a plan. And the problem that if you just don't know the industry trends or don't see them, you start adding in a bunch of administrative bloat for things that your specific company may not need. And that can be troublesome. I mean, the worst is when we see the ones where someone's getting the discount of claims and you end up paying your solution providers 2 or 3 times more than you actually paid the cost of service. Those are the ones that get really irritating and are the ones that are super hard to see, both as an employer and even as a consultant, see those things coming until you experience them.
Right. Let me give a quick commercial because we've done an episode on pharmacy benefit managers with Alex Stampf to learn a little bit about that if people want to. And then we did one on third party administrators with Matt McEwen. And so I think if you agree, Brett, that if people are interested in diving deep into either one of those, that both Matt and Alex did a pretty good job of explaining where both of those entities can become bloat or they can be massive cost savers and help with navigating things. They can hurt or harm your plan.
Yeah, those are both excellent episodes. And I'm sure we're going to have some other ones in our little library here that are good to go through too in the future, especially when we get into captives and stop loss and some of the other solution strategies.
Yeah, I just heard you commit me to at least 2 more shows that I haven't necessarily agreed to, but I'll do it. Okay, so you've thrown out a lot of things that people can be thinking about, asking their broker about. Of the things we've talked about, or even anything we haven't, what are the strategies that you've seen are most effective for employers to manage those rising premium costs without just shifting the entire cost burden to the employee?
Yeah. And that's where I love this conversation. In most employers, if you get past, it's too expensive for us to continue. The second part is it costs our employees too much for care, and the financial burden we're putting on them will break them. Like our team cannot afford, going from a $2,000 to a $5,000 deductible. Our team can already not afford a $5,000 deductible if something bad happens, and those numbers, I'm even throwing out what are kind of industry middle range numbers right now, not even the obscene ones.
Right.
So what I'm seeing are plans put in place that give good financial strategy to the employees where the company is working on being a good steward of resources and they're steering the employee and educating them to also be a good steward of resources. I mean, the easiest one that I think I see happen are those narrower networks or those tier 1 incentive networks where an employer says, hey, we're going to do $0 cost care for this subset of physicians, surgeons, hospitals, surgery centers, imaging groups, lab work, pharmacy benefits, mental health. Like these groups are people where we have had a good financial arrangement with that make financial sense for us as a company to share those savings with you either through $0, $5, $10 copay items versus having to go to your regular larger copays or going back towards deductibles, or your deductible in this network is $500. But if you want to go back to your regular network, which is totally still available for you in a tiered network,
Hmm.
you're just going to have to get to your old school $50, $60 copay or your $5,000 deductible instead of the $500 deductible. Financial helping the employees understand the value of the tiered network through financial incentives. That has been the biggest impact. Same thing happens on drugs. Even your high dollar drugs, if you go through, some of our specific drug focused solutions, we'll share those savings with you. You're instead of having your specialty copay of 200, we'll give this to you in for free. Meanwhile, on the back end, we're saving $3,000. Like, why wouldn't we give an employee, back their $200 for saving $3,000? Like, let's do common sense stewardship as an employer. And that really has been there. The other thing, when we focus on non-punitive ways to get behavior change or to go to the vendors that are going to cost us less in the future or even currently, it's looking at access to care items. One of those, investing in some version of high value primary care where we can try to get employees to use the primary care office before rushing to specialty, whether that's a direct primary care where someone's, available to them, super fast, super access, same person over and over again, or even some of the other clinic models, your on-site, near-site, not too many are doing on-site clinics, more using near-site clinics or contracting with a clinic to essentially become their near-site clinics.
Yeah. As you were talking, I was even thinking urgent care to go.
Those solutions too. And again, finding appropriate, like incentivizing for appropriate care. Again, the care metrics, like how do you keep people out of the ER? Well, give them a primary care first, give them an accessible primary care they don't have to wait on. Like those are your first two things. In lieu of that, how do you get them to urgent care? Or how do you get them to urgent care that's not going to overbill them as an emergency room, and find a vendor like Urgent Care to Go or Dispatch Health that we use a lot for those two items? Because are they higher cost than primary care? Yeah. Are they a lower cost than most urgent cares? Oh, heck yes. And again, you want to drive down, like you don't want to bring an incentive that's going to have a $300 bill to your claims fund when you can have a $65 bill to your claims fund.
Sure.
Like emergency room, you don't want to have a $5,000 bill when you can have a $300 bill. And again, finding the way to bring those costs of care down through incentives is what's working for employers.
Yeah. And I will also add, as a healthcare administrator, when you get your care at the appropriate site of service, it generally improves your care too. If you walk into the ER and you've got something minor going on and somebody comes in with a heart attack, they don't care about your sinus infection or your cold or whatever. Like, you're not going to get as much loving care and attention as you would get at your primary care doctor. So while the financial incentives are aligned, there's also like logical clinical reasons to try to get it at the most appropriate level of care. And if you think you're having a heart attack, go to the emergency room. Like, that's the right place to go. But bone is hanging out in your leg. But majority of the time, it's not your first and best stop.
Yeah. We insure I guess we don't insure. We're the consultants for the insurance for lots of high risk individuals.
Yeah.
And that may be, super white collar lawyers that love to base jump.
Sure.
That may be our more traditional mechanics or our motorcycle riders or our drillers.
Yeah.
Yeah. Everyone can have a high risk individual where something goes wrong, and the emergency, my baseball teams, how many like protruding bones have we seen in the last 20 years of old men that shouldn't be doing things that are a little too aggressive, that then, they don't want an ambulance coming. They'll ask someone to throw them in the back of the pickup because they know the cost of the care they can't afford. Like, we're doing things as individuals, risking things and injuring ourselves, and then going, I can't afford the care. Yeah. Again, good plans that have good solutions that give someone the ability to get the care when they need it at the appropriate site, and giving them the financial tools and educational wherewithal before that happens. Because again, no one remembers where you're supposed to go when a bone's coming out of your skin. Like, that's not going to happen.
Many times I've seen people call you on your cell phone in an emergency. I'm like, why are they calling the insurance guy? Yes.
Yeah. One of our good clients near death with, situation and calls me right after he's come back to life and his kids watching. I'm like, okay, like I'll do a few things for you over here to make sure it's easy on your wife. Like I can
Yeah.
do that and help her navigate this. Please go to the paramedics and go finish this thing as you're getting care flighted. Because
Yeah. But it's a good point, Brett, though, that educating everybody on the front end about their options is super useful.
Well, in education for most, if it happens at all, so most employers, not any fault of their own specifically, I won't fault them for this because they're buying a very expensive product that should do the education for them. Let me put that out there first. For what we pay, our insurance carrier vendors should educate us way more than a letter in the mail every now and then. They don't, or they want to charge more for those educational items, and no one's willing to pay any more than they're already paying. So, open enrollment tends to be your educational moment, which catches your population one time a year. Also, for most of them, in the holiday season. Good luck with that being remembered in March, June, or July during an event.
Yeah.
Other employers that do it better do open enrollment plus new higher education. Other employers that do it really well invest in like micro bite learning moments where they're able to push out small, simple things about their programs once a month or so. Maybe you can work it into like fun things like Slack and Teams channels with polls, small micro learning areas. We do see them do that. Those employers are investing in that educational moment
Yeah.
that is useful, non-intrusive, and small enough and frequent enough to be remembered.
Mm.
And those, again, plans that have those things built into them, plans that really have, the super creepy outreach to your cell phone when you're getting close to a pharmacy. Like it's super creepy that they're texting you while you're inside of a CVS or urgent care or an emergency room asking you if you need help in navigation. Like it's creepy, but it's also freaking genius because no one knows what they're supposed to do to maximize their plan benefits when you're sick or when your kid's sick or spouse is sick or
Yeah.
parents.
Yeah.
Like interventional technology is going to change and will continue to change and impact. But again, until an employee knows to expect it and is educated to expect it, no one trusts any of the messaging they're getting. Like
Yeah.
that's the other, I mean, you've had the episode with Heidi about the non-trust society. Like how do you educate an employee when no one trusts any communication channels because most all of it is either predatory. No, it's all predatory. There's no other word for it. It's bogus, BS, predatory. We're all subjected to because someone's trying to victimize us. And that's the way we all live now, knowing that we're about to be victimized by some predatory technology.
Yeah. Okay. Now that we've got you all riled up.
Yeah.
One final action-oriented positive question. If an employer wants to start making a more proactive approach to managing costs today, where do they start? What should they ask internally? And what should they ask of their broker?
Yeah. I mean, the first thing you should start is learning about what plan you have. Most employers we meet with that are not our clients do not know the ins and out details of the plans they have. So start there. Have someone educate you about what you have in place today. Sometimes we see great plans with horrible execution because they don't know what they have. They don't know the incentives built into them. Ask about compensation structures. Like that is like who's getting incentivized to sell this to? Like, is someone getting incentivized when we have a rate increase? Is somebody having incentivized when people enroll? Like, what are those structures? How do we have a good grasp? What is good? What is bad? Learn about the industry standards in your region. Like, learn about those things first. Have candid conversations with your broker advisors about that because that becomes the basis of a good business relationship. How much are you paying the people that are serving you? Now, for the most part, most often, it could be underpaid. But, I looked at one yesterday that was horrible situation where the compensation was probably double what should be on something of its nature and ilk. And
Ooh.
so there's a wide range that can be done out there. So ask about compensation, ask about bonuses, other carrier incentives, alignments, ability to sell different products, where they lie, like what are the lines someone's company has parameters on them? Like sometimes they're really good barriers. Like
Mhm.
we can't sell you something that's below an A minus financial rating. Like, okay, I'm totally fine with that.
Mm.
Like that's great. That's fantastic. That probably should be in place. Sometimes the parameters they're given are not quite so nice and clean.
Yeah. And I assume if the broker gets squirrely when any of those conversations come up, that's a very bad sign.
Across the board, probably yes. I know very few brokers in sales that don't know kind of what they're being paid.
Okay.
Most pay close attention to it because it is their job
Yeah.
to,
And and do you need to
and for a
ask
good reason.
separately? Yeah, yeah. Do you need to ask separately about the broker and the agency they work for?
No, no, it's one kit and caboodle
Okay.
in most cases.
Okay.
Again, caveats. In most cases, I'll leave it at that. I'll talk to you offline if you want to know the differences in there about compensation structure, but having the conversation is first level. Like
Okay.
learning about your plan, that's first level. Learning about compensation is 2 level. Learning about the parameters in which someone operates or how they operate with their other clients. What are their most innovative structures? Where have they seen failures? What are some of the initiatives they're starting to see and trends in their clients versus the rest of the industry? Those are the questions. And then, you know, educating yourself through like solution and point vendors. Like
Mm.
all of the solution point vendors have marketing out there that's publicly available for the most part. So if you're starting to look at direct primary care, there's marketing out there. If you're looking at concierge pharmacy, there's marketing material out there to some extent. If you're looking at stop loss and captives or wanting to go self funded, there's marketing out there available to you that you and your HR team should start educating and ask like literally ask your current broker what kind of resources they have to become better educated consumers. Most of them have that, or they can direct you to a source that has it where they can learn. And then you can come ask them questions once you know more and maybe ask better questions of them. Yeah.
And if people are listening to this podcast and hearing it, can they
Oh,
ask
us.
you questions?
They can ask us questions. They can come to our website. They can look at the podcast feed. Like we give away tons of educational content directed to employers, HR leaders, CFOs, benefits purchasers.
Awesome. All right. Well, thank you for caring mostly about how all this affects the end consumer. And then thanks for putting all the brain power you do into it every day to help take care of people and help educate people so that hopefully someday we can get into a place where we're not having increases every year and can keep those flat or even save money.
The more solutions we have that address the humanity of the person being cared in a financial way,
Mhm.
the humanity in a financial way, then I think we have a good, solid chance for much better outcomes.
Well, thanks so much to Bret Brummitt for walking us through the economics of health insurance and showing us that rising premiums don't have to be a mystery. With the right questions, data, and partners, employers can take back control and build plans that are sustainable, affordable, and still generous.